Welcome back to another episode of the Anomaly Angle. And today we're going to tell you why you should not be an S Corporation. A lot of people just say, hey, let's be an S Corporation. We're going to tell you why you should not be an S Corporation today. So follow along this episode and we'll give you some really good tips. But before that, John, how we doing? How's the summer going so far?
So far, so good. You know, the summer slows everything down. We just had our big company retreat. We're remote, so we bring everybody to one place in the US. We even had some of our international team with us for the first time. We don't focus on work. We just focus on, our culture, getting to know each other. It was really a great time.
Yeah, good times. We were in Rocky Mountain National Park in Colorado, did some hiking, did some tubing, all sorts of good stuff. Stayed in Boulder, went to the stadium, hung out. So awesome times, got to connect with people, but summer's flying by here, and summer's a great time to think about tax planning. Today we're gonna talk about S Corps. Now, funny, I was watching a Instagram video last night. It's that kid that does the, hey sir, like how'd you become a millionaire, right? And they tap on people's shoulders and they interview them. And he was advertising on the video with this company that said, if you're an entrepreneur and you want to start a company, click on this link and it'll set up an LLC and set up your S Corporation right away. And I looked at that and I almost fell off my chair because I said, what horrible advice that is. And I saw hundreds of people below comment the word to set up their S Corp, and I'm just shaking my head here. So let's talk about why this is a problem. S Corps are wonderful tools, right? Subchapter S, they were created by Congress to help certain small businesses, but what people don't realize is they operate under the corporate section of the tax code, which is extremely rigid. Rigidity leads to problems. So let's talk about the reasons why. So the first one we'll talk about is too early.
Right, yeah. And I think that's like the big thing that you said is that it is a wonderful tool. Like it's a great tool for a lot of different scenarios, but it's not for everybody. And you can't just stick yourself into an S Corp because it's very hard to unwind once you do. Almost once you're in, you're kind of in. And being early is one of the big traps, right? So the big thing that we're looking for is you need to be at a critical mass. Like you need to be a certain threshold of profit for it to really matter, right? An S Corp, the biggest part of it is that it's mitigating that self-employment tax. It's mitigating, Social Security and Medicare taxes. So if you're not at a certain profit threshold, you're just adding a lot of burden, which is, you have to run payroll. You're gonna have another tax return, right? So there's additional costs that are associated with it that will eat into the benefits until you get to a certain point.
Yeah, and for the taxers out there, there's some other issues as well, especially if, let's just say that's a small S Corp, $40,000, $50,000. So yes, there is some FICA tax savings, but you're also reduced what's called QBI because of that. So when you add that all together and add in the compliance costs, the payroll filing costs into that, if you're not at least, right, this is no rule here, but at least 85, 90,000, not of revenue, of profit, it's not really worth it to start. Now, if you're at like 60K and you're like, I'm gonna be there in 6 months and a year, okay, sure. But we see some people limp along, they come in 40, 50,000 of profit, they're just solo shops starting on their own. And it's like the math doesn't really math, right? It doesn't really work when you add in all the extra costs, the headaches, it's extra compliance costs, and there's complications. Here's the other part of it. You wanna be an S Corp, you gotta be a big boy. You need formal accounting, you need balance sheet, right? You can't wing it like a Schedule C. A Schedule C is nice because the IRS doesn't actually require you to report a balance sheet, which is a whole nother topic and another situation, and it's a really poor choice by the IRS. But S Corps have to report a balance sheet. You need reconciled capital. You can't do that on an Excel file. So you need to really invest in the business to do this. And oftentimes when we tell people all this and we say, well, you add all that up and you're making 50K, your tax savings is zero or even inverse, right? So be very, very careful if it's too early. Almost never would we say form your business and start an S Corporation. Form your business as an LLC. You can even do an S Corp election retroactively in some cases, right? It's tricky, but you can do it in some cases. But never, ever, ever start the business and on day one file as an S Corp unless you have this master business plan that you're positive you're gonna have that amount of profit in that first year. So that's number one. Okay, number two reason why you do not want to be an S Corporation is if you are taking on or have debt. So let's talk about that, John. Like what kind of businesses here typically are going to be looking at some kind of debt profile?
I mean, we have a lot of say you start off as a partnership, it's you and another individual, you're really trying to get the business off the ground. It could be a service business, and you take on a lot of debt. That's going to become problematic if you ultimately determine to elect to be an S Corp down the road.
So that's one thing. And actually, typically I see it in more capital businesses. So think about any type of business. Well, obviously real estate, right? It's going to have debt. You never, like, let's not even talk about real estate and S Corp. That's just like a red flag. Never do that. But product, Amazon selling, right? Businesses that are generating inventory, you typically need to finance inventory, and you can't finance inventory off your bank account. So they usually have some type of loan. It could be the short-term loans. It could be high credit cards, many different things that people use to finance. There's two reasons why debt becomes a problem with an S corporation. Reason one, which John alluded to, is the complicated one, is that sometimes you may have debt, right? You might have a big loan. It could be a loan from a family member. That loan is on your balance sheet. If that loan is basically greater than the sum of your assets, your cash, and maybe your AR, you have an excess liability over your assets. I mean, now I'm getting into the weeds. When you become an S Corp, that can create what we call a phantom gain. It's in the corporate tax code. That's a problem, right? That doesn't happen as much. The second reason would be this. You hum it along, you start an S Corp, you're moving, then you're like, oh, I need to finance some things. I finance it with debt. That debt creates a loss for me, meaning I put $100,000 into the business. I invest that $100,000 into hiring maybe, or buying product, whatever it may be. And on my tax return, what's all reconciled, depreciation, I have a loss, right? So my K1 has a negative $50,000 loss on it. Here's the problem. Debt in an S corporation does not give you what's called shareholders basis, right? So in a partnership, the recourse or qualified non-recourse financing gives you basis, right? So basis is really like the reconciliation of how much you have in and out of the business, right? In a partnership, the laws follow that you get credit for debt that you're liable to pay back, right? So if you have a loan in the business's name in a partnership, say $100,000, that $100,000 gives you standing in the company, right? In an S corporation, that same $100,000, that same loan you take out does not give you standing in the company, meaning when you have that loss, you might not have enough standing in the company, or as we say in the tax world, basis, and people get lost here. But then the problem is that negative $20,000 on your K1, it's not usable. It becomes a suspended loss from lack of basis and carries forward with you. So people get shocked by this, and then this can go on for years where you're actually losing money and you can't use the losses. So huge problem we've seen with clients come in that have S corporations. And I kind of point to B here is that getting out of the structure is also not easy because, well, first people say, well, okay, I'm always going to be taking out these high loans. Can I get out of the structure? And the answer is not that easily either, right? Because you can revoke an S Corp election and then you become a C Corp. And then people say to us, no, we were never a C Corp. Doesn't matter. It goes S Corp, reverts automatically to C Corp, then back to partnership. It gets tricky here, but again, you're hearing all this complexity because these are real life scenarios that do happen that we need to be aware about.
Yeah, for sure. And I think like the moral of the whole story is that, once you do elect to become an S Corp, like you're going to have to jump through all these hoops. There's all these rules, 5 years. And like revoking it is like Greg said, you immediately revert to being a C Corp, which you may not have been previously. And that causes all these potentially taxable issues, especially if you have a lot of assets. Like Greg said, you have a lot of debt, it can be a problem. So that's one of the big things we need to hit.
So learning lesson here is just if you think you're going to take on financing in the form of debt, be careful, right? If it's in your business plan, it may not be the best structure unless hey, I do need some capital, but we're still going to have a super high profit, right? So if you're in your head, it's like we're going to take on debt and we're going to have losses from that debt, might be a problem. Okay, number 3 is this, right? Partnerships, having multiple people involved for an S corporation at the company level can be a problem. It's not impossible, right? S corporations by statute can have up to 100 shareholders. Now, those shareholders, there's all sorts of rules. You cannot have foreign shareholders in S Corp, which is just a law that's been there forever. That doesn't come up very often for us actually, but multiple shareholders becomes a problem. Why is that? Well, the rules of S corporations means everything has to be proportionate. So if John and I have an S corporation and it's 50-50, everything that happens has to be 50-50. In other words, $1 out of distributions has to be 50 cents, 50 cents. We can't say, oh, you get 60 cents this month, I get 40 cents. It has to be proportionate. That's just the rules that apply here. So that is a problem for a lot of partnerships because partnerships often have what's called special allocations, meaning meaning they have agreements between each other that, hey, eat what you kill, right? Some people do eat what you kill. The legal model is very much like that. Certain preference items are allocated to others as long as there's a potential economic effect. That happens all the time. In an S corporation, you can't do that. You cannot have special allocations, and there's only one class of stock. So you can't have like profits interest, right? If you want to give a key employee a profit interest, you can't do that in an S corp. It's the second class of stock. So everyone has to have the same class of stock. So that's a problem. Like, so think cap table wise, if you're going to expand the cap table beyond yourself and someone else, pump the brakes, because it's very inflexible to expand the cap table. Now, pushback would be, well, I thought a lot of services businesses that have partners are S corps. They can be, and this is what they do. They have a partnership at the top level, right? So law firm LLC is the partnership. That law firm LLC is owned by sub S corporations of the people. So if John and I owned a law firm, he would have S Corp 1, I would have S Corp 2, the other partners would have S Corp 3, 4, 5. So you're getting the S Corp benefits, but you can do all the funky partnership allocations at the top, allocate down to the S Corps. That's not a one size fits all thing. That is just what some service businesses tend to do to get the S Corp benefits while keeping that flexibility at the top. So that's a very common thing. When we hear people say, oh yeah, we're gonna start, we want the S Corp benefits, we're gonna hold this forever, it's high cash flow. Yeah, we're gonna give 1% or 2% to our employees in a few years. You know, he gets more if he brings in the big insurance contract. And no, pump the brakes. That is not a good S Corp situation, because you're gonna get disrupted by the lack of flexibility with the cap table.
Yeah, I think that when we say multiple partners is like the trigger here. It's just that the more people you add, partners, the more complexity comes in. So just abiding by those pro rata rules, it just becomes harder and harder when there's more people, there's more mouths to feed, there's potentially, performance differentials in the partners and that sort of thing. I think we also see with people that are, coming from like the C Corp world, they're probably, a little shocked at just the rigidity of S Corp cap tables, right? They come from the world of like stock options and RSUs and all these sorts of things. Yeah. Can't happen. And the same thing is true for people that are, like Greg said, that are, kind of an eat what you kill model, right? In a partnership, can't have that in S Corp. So that's why when you get more and more people on that cap table, it just, in our experience, the less and less a chance S Corp is the right structure for that.
Yeah, exactly. And like, let's go to the next level here is that John kind of mentioned the C Corp investors, right? So if you're either going to have someone invest in your company or you're going to sell your company, S Corps can be a problem. This is a tricky one because someone may say, well, I'm going to operate for 10, 15 years. I'm going to make $400,000 per year. S Corp tax savings make sense to me. I don't want to worry about selling in 10 years. I completely agree with that. You just have to be aware at the end of that tail there when you're going to sell the business, it's not the easiest business in the world to sell. There are planning maneuvers around this. So if you're, say, running a marketing agency and you want to sell that S corporation, two things are going to happen. I've almost never seen a buyer come in and just say, I'm going to buy the stock of your S corporation, especially if it's a larger buyer, because they don't want to step into your shoes in this rigid structure. So they're going to do a few things. They might recommend what's called an F reorganization. They may just strip the assets out of your company and bring them over. There's different ways to do it. But asset sale for you as the S Corp owner is not favorable. You want to sell the stock of the company. Now, there's all sorts of funky planning things we can do here, but just be aware, it's not a sexy sellable asset in the S Corp structure. I've never seen a private equity company, I've never seen a venture capitalist come in and say, yeah, sure, we're just going to invest directly into the S Corp. We're going to buy the S Corp. They don't do that. They're going to either force you to do a drop-in swap or a conversion and convert to a partnership, which is going to cost you a lot of money, tax, legal, accounting fees, or they're going to strip the assets out and you're going to get an unfavorable tax treatment there. So that's like a cart before the horse thing. You shouldn't stop a good thing because of that, but you need to be aware of that. That's definitely a big thing we see. And what John alluded to before too is if you're just going to like scale a company and you're going to take on 10 VCs over time, you just can't do it. You can't do an S Corp. You can't give stock options out, right? So we talked about debt, right? So think about the balance sheet. Debt and equity, unflexible with an S corporation. If your capital stack is going to be more than just cash flow, if you're going to rely on debt and equity, pump the brakes, talk to an accountant, because it may not be the right fit for you, even with your profit level. So
with this topic, it just kind of hammers home the point that when you're really thinking about growing your company and making an S Corp election or figuring out the entity structure, it is super important to know, hey, this is the vision that we have for the company. Are we just going to be this like operating cash flow monster, or are we going to be, we need to raise capital, we want to sell? Like if you want to raise capital and sell, S Corp it's just never going to work. So it's just important to nail down that vision.
Last thing we'll say here before we wrap, I alluded to before, and we won't get into this one in depth, but I don't know why people get this advice sometimes online, is do not ever buy appreciating assets, real estate inside of an S corporation. Why? You're gonna have a double tax. It's impossible to get out later. Way back in the day before the 80s, S Corps had some real estate and they're hard to unwind. Unless you're flipping, right? You're doing ordinary income flipping in real estate, meaning in and out. That's ordinary income. It's inventory, not an asset. You can do it. If you're buying a property to hold, just period, end of story. Do not put that in an S Corp or even a C Corp, right? Bad idea. Don't do it. If someone tells you to do it, run really far from them if they tell you to do that.
So how much we see that happen.
Generally, it's by mistake. It's by someone doing it themselves. They listen to the Instagram thing and says, form a business, click here, form the S Corp. And they're like, I didn't even know what I did, right? But the problem is, once that's on file, you can't just remove it. People say, well, I'll just take it out. You can't, because if you bought the property at 100,000 and it appreciated at 400,000, you're having a deemed distribution at 400,000. That's a gain of 300,000. You're paying a tax and you stolen the property. That doesn't seem right. So just don't do that.
The other piece too is that, like we said, the actual benefits of an S Corp are primarily to mitigate self-employment tax, and rental real estate
Doesn't have it. Yeah, it's not a good idea. So that's it, right? So S Corps, right? They get a lot of praise, and look, they have a wonderful place in the tax code. They do wonderful things for people, but we're here just to push back on the other side of it, right? Is that S Corps are not an end all be all. You need to start your business and you need to have a plan, talking with an attorney, talking with a CPA, licensed tax professional on your entity structure. And the more you know about your long-term horizon, the better. Almost never should you trust an online filing service to do this, because all you're going to do is make a move that potentially is irrevocable that you could regret down the line. So that's it for today. Now, if you want to learn more about entity structuring, some of the planning techniques and how we figure this stuff out, check out our website, check out some of the links in our bio and get in touch with us. And we're happy to have that conversation, hopefully plan the right entity structure or even a multi-entity structure for you. But that's it for today.
All right. Thank you for joining us.
Take care.